Lovely to have you here again. Very special night tonight, all about financing your business. Not only whether that's a startup or if you're buying a business, you've got some great guests. So Ali Dhirani is here to talk about cash flow. I know you had a great time with him a couple of weeks ago. You're going to have a great time with him again tonight. Then we have the lovely Nephra Jacob, who's going to teach you how to get some money from the bank. Very important. And finally, Lizzie is here to talk to you about buying a business. So, without further ado, Ali Dhirani, come on up. Yeah, my friend.
Well, hello everyone in the room and obviously online. My name is Ali. I'm the director of SAMAF Consultants. For those of you who are new to SAMAF and new to myself, we're an accounting financial service firm that is based in Darwin. I have an office in Melbourne City and Nephra and 21 across the 4 states. As part of the workshop, we spoke about where's my cash going. A lot of people in the room are probably aware of cash flow, or Lizzie yourself, Nephra, you probably deal with worksheets all day long. So this is going to be a piece of cake for you, but for those people, but I'm sure we can learn from each other and perhaps something that we can highlight and refresh our memory. I always start any presentation by saying that cash is king. And I come from Africa. I grew up in Tanzania, and when we refer to cash is king, we actually mean cash is king. But in this day and age, it doesn't really matter whether it's physical cash or it's digital currency, but seeing that profit, seeing that cash in the bank is the most important thing. And I'm sure that for any decisions that you make as a business owner or as an individual, for buying businesses, or even when it applies when it comes to grants and stuff, your cash flow forecast, your bank statements, your cash flow outflows and inflows are very important. And that is what we're going to talk about in this presentation. So it's a really touch on what is cash flow, and I'm sure I've kind of went through this presentation and changes were being made in the first presentation. So I'm sure that whatever we're talking about will be carried forward in much detail by then. So without further ado, we have this question about where's my money going, which is something that we ask even in our personal life, right? Like, oh my God, I'm making $100,000 at the government and I'm doing really, really well, but where's my money going? And even as a business owner, sometimes we realize that profits are looking really, really good, but then the bank statements are eventually, and in certain cases, there's so much other liabilities that are hidden that you won't see. And I'm sure that later on in the presentation, all of those things become red flags, right? You need to be very, very focused on what you do. And when I say cash, again, to reiterate, when I say cash flow, it also means money coming in through your bank, through your Square, through all of those means, because as soon as there is cash transactions, there is uncertainty. There is no transparency, and there is always risk, because that could come, that could not come. So basically, when we talk about cash flow, from very layman's terms, it's money coming in and money going out. Obviously, there's more details on it, on types of cash flow that we're going to talk about later on. But there's positive and your negative. If money coming in is more than money going out, then you're in a positive. And if money coming in is less than money going out, then you're in a negative. Again, negative cash flow is a red flag, and that is something that the banks, government, grants don't like see, especially if you want to sell it. Now, when we talk about what is cash flow, a quick small example. I run a small cafe. I earn $4,000 a week, but spend $4,500 on supplies and wages. That's basically negative cash flow, $500. Now, we've spoken about money coming in, but let's touch base on what are the avenues or places where money comes in from, or what are the types of cash flows. And in accounting terms, because that's my forte, as an accountant, whenever we do a cash flow forecast, or whenever we talk about cash flow, we talk about it from operating side, your investing side, and your financing side. Now, not necessarily this may relate to small businesses yet. However, when a small business wants to grow in one way or the other, it's very important in looking at investing cash flow and financing cash flow, because for many decisions as a small business owner, purchasing assets or making an investment into a commercial property, all of this will then be referred to your investing and your financing cash flow. Whereas your operating is your day-to-day cash flow, yes.
Would you include in startup the personal money that you're putting into it as financing cash flow?
So when we talk about, now that is where we come into the operating cash flow. So whenever we touch base on an operating cash flow, we talk about the day-to-day transaction. Now those day-to-day transactions have to be paid out somewhere. It's either we do revenue or we provide a service, we're selling a product or selling a service and the money comes in, or your opening operating cash flow will be your personal money. So if you're introducing that to your business as an opening balance or in your opening cash flow, will start in with your personal money. However, there is accounting, things that happen to it because that is then reported as capital and it becomes part of your balance sheet rather than actual your revenue. But for your cash flow purposes, yes, because when there is an outflow, there has to be an inflow from somewhere. So it's basically your day-to-day earnings, what is included, your payments, your bills, your service revenue, all of those things. When it comes to your investing, you're basically talking about buying and selling assets. And when you talk about your financing, it's everything that includes loans, capital, repayments that you do in case you want to go use invest. Yeah. So a tip for small businesses, your operating cash flow is like the most important thing. That is like your holy book, operating cash flow has to always be positive because that shows a healthy business, right? Even though whatever is in your investing in your financing cash flow, but if your operating is doing good, then there is always tweaks and efficiencies that you can introduce to either increase the revenue or at least bottom line. And again, we're open to questions and any comments you guys would like to make. There's some professional here, so please feel free to add a little bit of your touch. All right. Now, what we hear about this big cash flow forecast. Everywhere we go, we apply for a loan. Even when we apply for a personal loan, even for a personal finance, even when you want to buy a mortgage, they also ask you for your cash flow. It's your incoming and outgoing. So for something like a cash flow, yes, it's important for a small business, but it's equally important for our personal finances too, especially if you want to grow our wealth in one way or the other. And why it matters so much? When we talk about it from a business point of view, it helps you avoid missing bills and payments. And when I talk about bills and payments, at this current point in time, I particularly talk about the ATO, right? We work with the tax office a lot. Back in the day, ATO was the last person that you would think about paying. That is not the case for small businesses as their current policy at the moment. Small businesses are the target for ATO. They're always looking into us. That means that all our obligations, such as GST, such as KYG, such as SUPA, are closely monitored. And that is why you don't want to avoid that. Because even back in the day, when all that payments included interest, and you could claim that interest, starting 1st of July onwards, that interest is not deductible. If you have a loan with the ATO that was accumulating interest, you can't even deduct it anymore. What I tell my businesses, if you have an ATO loan, you'd rather take a loan from outside, pay off the ATO, at least that interest outside is deductible, because this here is not, plus all the stress that you get and all the phone calls that it could even lead to direct debit. When I talk about avoid bills and late payments, in this particular scenario, in this particular time, it's the ATO. Always make sure that your GST applications and your KYG, which is your employees, because that forms part of your operating cash flow. The daily incoming and outgoing. Allows you to plan better, no more paychecks to paychecks. I've lived that life, for a very long time, as long as I can remember in Africa and also coming to Australia as a student. I don't want to live that anymore, and once you start not living that, it's fun. When you know that you have 2 weeks of advance payment, or I know that for the next 3 months, my payroll is sorted if I have no revenue. So Gucci, so that's what matters at the end of the day, that it helps you to plan better. And again, business is very closely related to the person, especially if it's an owner-operated business. your personal life, your personal mindset, your feelings have a direct impact on the business as much as you say yes or no. If you're having a bad day at work, you'll have a bad day at home. And if you're having a bad day at home, you'll have a bad day at work. It just kind of goes side by side. But as an employee, that doesn't really matter. But when you're running your own business, that can affect your growth because that one day can become two, and then we have a multiplier effect where the whole week has been slack and you have no operating cash flow coming in. So for us, it's very important to do that. And obviously, at the end of the day, whenever someone starts a small business, the first thing I do in my consultation is I tell them that always start your first business by thinking of the end. So you start with the end in mind, even though you don't want to do it, but think about that one day I'm going to own this company and I want to sell it. So automatically from day one, and I'm sure that you're going to talk about whenever you're buying a business, but from an internal point of view, from day one, you're building something that will create value at the end of the day. Whether you sell it, whether you give it to your kids, whether you pass it on or you donate all the proceeds from it, it doesn't really matter. But that mindset is the most important thing. That's what leads to investor and lender confidence. So I know the gentleman right there was talking about some AI and all of these amazing things that you have in plan. As soon as your cash flow is good, as soon as the revenue is coming in and it's looking healthy, automatically the investors will come and let's talk. It's a little example, earnings $1,200 a week, expenses of $900, $300 saved for two with tax. Arrow has positive cash flow and a peace of mind. Most important thing whenever we're running. Now, when we talk about, I just have to skim quick because we have a few presentations, I'm sure. So again, please feel free to butt in and ask questions whenever. But there are some tools that help you track all of this. And especially if you're going to work with an accountant, this is going to make, first of all, your billable hours less because you'll be spending a lot less money. And second, you have data right there recorded. So I know a lot of people do not go into an accounting software from day one. But again, when I ask someone who's starting a business, that from day one, you only got into the business because you wanted to create something. You had a vision for it. You love what you do and you want to create something out of it. So why not include all the resources that you have from day one? And it's not necessarily a very expensive thing. QuickBooks is like $12 a year or $15 a year. Even if it's just standard, as long as digitized, all your bank statements are all into the accounting software, it really, really helps with cash flow and anything that you want to present at the end of the day. It helps you track your money. Obviously, it's digital receipts and invoice from time. How many of us have files of receipts at home? I had back in the day, now everything is digital, but I'm sure that if we visit our grandparents' house, even till today in Africa, I'm sure they have a whole cabinet of their storage of files and receipts and invoices. They probably have faded over time. So that's what it helps. And again, coming back to our most important thing, which is your cash flow. Because it is digitized, it's automated. As soon as you run a report, you have that right away. Your cash flow, you don't have to do your bank statements and do everything manually. Now, this is probably a question for all of us in the room, and people online can feel free to give in their point of view. We have a situation here. We have our income of $5,000. We have a rent of $2,000. We have supplies of $1,000. We have wages of $2,500, and we have utilities of $400. So in our current scenario, our expenses are $4,000, $5,500, almost $5,900, $900 more than our income. Now, as I asked, how do we fix that? Let's say if this was our business, or if this was our current scenario. Let's say if I was earning $5,000 a month as a wage, and those were my expenses, what would we do, to fix this? And it doesn't have to be right or wrong. It could be anything. Anything, yeah.
Just reduce our supplies until coming out.
Okay, that's good. That's one, yeah, sure.
Can you get rent cheaper somewhere? Do you need a shop front that costs that much?
Yeah.
Do you need that many workers? Can you minimize it down until cash flow goes up and hire other people? And buy more supplies than you need for that month?
Okay, so
So
is it just the rent or is it supplies, wages, or everything? There's not one particular thing. Good, yes.
Increase your hour rate, is correct.
increase prices, right? Correct. Anything else from around?
Sell more.
Tell more? Okay. Now, this is what answers the question, right? This is exactly what I wanted. Everyone has those tips and tricks in mind. We just have to implement it. And this is what we fail sometimes, personally included, as business owners. That we exactly know where the issue is. We exactly know what to do, with our thing. We exactly know how to maximize revenue. We know all of that, but we don't implement it. And why don't we implement it? Because we don't have the numbers in front of us. And why don't we have the numbers in front of us? Because no one gives a shit about cash flows. At the end of the day, excuse my French, but it's the reality. We work with so many businesses, and I'm sure that people here will vouch to that. That yes, we look at our profit and loss and all great, but in terms of actually looking at our cash flows, we don't. Even personally. And this is where as soon as someone just starts writing things down, putting in the percentages like you mentioned, talking about whether we can increase, reduce the expenses. But remember that these expenses, because you're incurring them, is why you're running this revenue. So there is a kind of a relationship between the expenses and the income. And that is why the first thing Lizzie mentioned is you increase your prices. Let's see how that makes a difference without reducing your staff, because the rent, perhaps maybe it's a really good location if you have to pay that. Otherwise, it won't complement with your revenue. Again, with your wages, right? Perhaps maybe you need that number of staff in there, minimum number of staff, because of higher wages, higher super. So some, and supplies again, unless you look for a cheaper supplier, you probably need $1,000 of supplies to actually produce $5,000 of, revenue. So all of those things, not saying that they cannot be efficient and effective, but the first thing you start looking at is how do I maximize revenue by increasing prices or selling more, and then go into the expenses, especially for the business. Because as a business, this side is always an opportunity. It's always open. Whereas in a personal case, this income always has a ceiling. The expenses is what we have to work on. This is what the opportunity as business owners we have, and it directly coincides with how much work we put in. So that's the other thing, that whenever we sit with clients and we tell them to actually prepare the cash flow, and we tell them, okay, let's write how much you're going to make. The main thing I tell them is you predict your cash flow, just don't hope. Because we have to be practical in life. Yes, I've got a great product. Yes, I can look after anything. Yes, I'm a great accountant, but I cannot do $200,000 in billable hours. It's just not be possible, And that is why we don't hope. So it's very important to estimate future inflows and outflows while being very, very practical. And sometimes, as a business owner, even if you need the extra help, and which is so much available, like there's resources available, vacancies available in terms of speaking to them and getting a third party involved in doing this process. Because sometimes as individuals, we always minimize our expenses and maximize our revenue, whereas someone from the outside will always be conservative with their income and be quite relevant with their expenditure. Plan for the slow months, especially now. We know that November, December, January, February, retail businesses, hospitality businesses are the ones that take the hit the most. The last presentation I did on start on cash flow and other presentations, we did a little bit of stats on how many businesses in that retail industry actually failed, not only in Dhabi, but across Australia. Just for many, many reasons, and it's mainly cafe, hospitality, restaurants, the taking it. And unfortunately, the ones who take the hit are the ones that are actually owner-operated share. So if the partnership restaurants, when someone is a business person and someone who runs a restaurant or the cafe, those businesses tend to work a lot more better than someone who's just a chef and running his own restaurant. Because again, when we look at the income and expenses, and when we look about, hoping my food is amazing, I think I can serve 100 people, we have to be a little bit realistic. But again, that's just a small example with what is happening currently. And again, use your templates of software that are readily available. They can be shared with most of us, a whole cash flow spreadsheet, everything. Just populate, and the numbers just split up. Understanding the cash flow statement, start with your opening balance that we spoke about, whether it's coming in from a loan, whether it's coming in from your personal finances, whether it's something that you've received from the bank, anything. add your cash in, anything that comes in revenue, remove it, and you have your ending balance at the end of the day. It's as simple, and I'm sure there's a lot more detail to it. It's not as simple as that, but as a starting point, it's as simple as that. You know, so your business starts off with $2,000 and you earn $5,000, rather than 2,000 came in from yourself or the business or loan, whatever. You have $7,000 in revenue, you have $3,500 in expense, so you close the balances, 3,500. Just simple math. Now, I go into a lot more detail whenever I do about my accounts receivable, accounts payable, inventory, you know, sales and revenue presentations. But these are some tips that you can do straight away as small businesses, and I'm sure that you know, a lot of people are going to, you know, benefit from it. One is invoice faster, reduce the days from your 14-day turnover to 7 days. Your payroll runs fortnightly, automatically you have twice the cash received than what you're paying out. Simple, you know, it's the first thing that you can do. Obviously, there's constraints here when it comes to government, or when it comes to some organizations that have fixed payment terms, then you can't work around. But if it's just individual businesses, then reduce. So I actually did an analysis, a personal example of my business in 2023, and my age receivable dates was around 35. So for an average, it took one invoice 35 days to be paid. And I was like, holy shit, I'm actually letting people use my money for 30 days and not myself. That means I'm actually paying twice the payroll than when I'm receiving my money. And just by making that change, I got an extra $50,000 in hand that gave me a peace of mind, and I could plan in advance. But now our age receivable days average is 4 days. So we get paid within 4 days from 35 days. And that is a direct, you know, relationship with your revenue, with your cash flow. Revenue stays the same, but the cash in the bank goes straight up and creates a peace of mind. I can do my investment straight away. I can do all my financing that I need. And so good. Follow up on overdue payments, something that I see with a lot of small business owners. We probably issue invoices and then we go in with our work and forget about it. You know, and then we realize, oh shit, something is 100 days old, someone that I sent it to and doesn't even remember. So always look at your overdue invoices. Early payment discount, that's what I've seen with government and a lot of bigger organizations that take 30 days or 45 days to pay, offer apart from NDIS, if you're in that sector. But anything else, if you offer a discount, everyone's going to jump on it. You know, it's just how we are. Non-essential costs, because you know your cash flow better, you know, you kind of just remove everything that's not necessarily miscellaneous or other, you know, as we like to talk about it. Delay big purchases, this is something that I personally have a problem of, you know, the watches and the cars and, you know, all of those risks. All the things, we all have our guilty pleasures, and as long as I'm paying my tax, I think I should be all good. However, 7 days is something that I do, and it's worked tremendously with myself. Before I want to make a big purchase or do a big investment, I take 7 days to analyze everything, and then I eventually don't buy it. That's what happens to me. Build a cash reserve, you know. Now, when I say cash reserve, in this term, when I talk about cash, again, it's money in the bank, it's money in your retirement, it's money in shares, it's money in your portfolio, all of that, right? So while we have our investments and our real estate and our houses, it's also important to plan in a way where we can actually physically see our cash multiply. Stocks, shares, your super, which is a great tool as well. Without any investment, you can have that. So all of that play a big part. Yes.
Just on the overpayment reminders, saying that follow up on your overdue, what do you think people should be putting in as their overdue reminder limits? Let's reduce that time frame of payment down.
So 2 things that we normally do is 1, automating the system. So send something every 7 days if your payment term is 14 days, 1. And second is late payment fees. That's it. So as soon as you reach the 7th day or the 8th day, that is according to your invoice, to pay within 7 days. Otherwise, late payment fees will apply. After the 7 days, automatically, the late payment fee for $5 is applied. But someone will delay $1,000 payment, but as soon as you put a $5 late payment fee, they'll pay it straight away. Tendency, you know, normally, and we've seen it with our parking fines, right? We delay the $40, but as soon as we get the $44 fine, we're like, all right, let's just pay it off, you know. So it happens, it works. You know? Anything? And all right, common mistakes to avoid, don't fall into this trap. I'm sure we're going to discuss about this in detail. Not setting aside money for tax, important thing. The ATO is the most important thing right now. And now it's important to anyone else right now. So make sure you have money for tax. Remember, profit does not equal to cash. So even when you go with your profit and loss and be like, oh, I have a lot of, profit showing. But then your cash flow is negative because you have all these taxes you have to pay. Then it's not a profit and loss item. So always make sure that your profit is not your cash and have a look at both the statements at the same time. Ignoring small daily expenses. I always say your $5 coffee will not let you buy a Lamborghini, but your $5 coffee expenses monitored will definitely lead to growth in the business. As long as you have it accounted for. Spend it, doesn't matter, right? But as long as you're keeping that accountability for yourself, it's great. Put it as part of your cash flow and enjoy life. That's what I said. We don't have to be very, very constrained to whatever we do. And again, your late invoicing equals to late payment. So as long as we do that, we want to fall into that cash flow trap. That's pretty much it. Cash flow equals money moving in, so money coming in, money going out. Make sure we track regularly whether it's personal or business. Use the tools that we have available, and obviously forecast ahead. Be realistic. Avoid the traps. Keep it simple. You don't have to go have like 20,000 spreadsheets and have every small thing detailed. Keep it very, very simple so it works daily for you. But at the end of the day, keep it consistent because you won't see the fruits of it until you actually do your cash flow for a month, for 3 months, for 6 months, annually, when you actually see the benefits out of it. Any questions, comments, recommendations, criticism? Open to everything.
Just to, with sort of debt of cash, is that, how's that affecting small businesses? In the sense that, is cash flow getting easier because payments are electronic now, or it's just, we're literally, nobody's paying with cash anymore, you're paying with coffee, with their card, and whatever. How do you see it if you're looking over a multitude of businesses?
Yeah, good question. So with the cash economy in the Northern Territory, it's probably not applicable at all. Back in the day, I really down for 10 years. So maybe at the start, we went to the markets and stuff, we were on cash only, maybe a couple of takeaway restaurants with cash, everyone except cards. But that whole picture changed when I went down south. Sydney, Melbourne, Perth, not so much, but Sydney and Melbourne, there are places even inside the shopping center that says cash only. So there's a big, big, big cash economy down south.
Yes.
Which I wasn't aware of until I went there. And then people are receiving money in cash and a lot of cash. There's a lot of traders who build $300,000, $400,000 houses on cash. How to do it, where to put the money, that's probably a discussion for you there, and I'm sure you can touch base on that as well. And how to structure and things well. And you don't get asked too many questions, but yeah, it's something that exists and exists there.
You mentioned there were some templates with cash flow.
Yeah, so
I'll come and tell you about them in a second, and I'll tell everyone online. Yeah.
Well, if there's nothing else, thank you very much. I don't have my number, but I can get back to you later, but that's not our email address, and that's our website, social media, we're always there, with my Twitch content sometimes, so yeah. Thanks very much, guys.
Thank you very much. I've said it before, I'll say it again. Ali's one of our providers. We can provide access to professional services thanks to the Northern Territory Government. So when we do start a business and we like a little bit of help, we can send you to speak to Ali. The link that you mentioned, so every time you get an invite, there's a link to the course content page. And at the very top of the page, there's like 5 different downloads. And one of those is a cash flow, two sheets on it, your startup cost and your cash flow projection for the year. All of the calculations are done for you. You only need to type in the costs or what you expect the income to be, and it'll do all the lovely work for you. Okay, so even if you don't like spreadsheets, next, you have the lovely Nephra. Nephra is a territory business advisor and she formerly was a small business banking advisor, is that correct? She's going to tell you how to get some of that lovely cash out of the bank. Nephra.
With the Department of Trade, Business and Asian Relations as a territory business advisor. My role in my job in this role is to help small businesses access different levels of support, go through different phases of business, so it could be, right from concept, to startup, establish, all the way to exit. We work with different partners and organizations like Bank MT, depending on what phase you're in. So, I'm from a banking background, so that's why I'm here to talk to you about accessing that capital and hopefully get you started. So, let me just start by asking a simple question. If money was an issue, would you launch that startup business, expand, or invest in the next big idea? But today, the whole idea is, something kind of at the very heart of that, which is capital. But it's not just money. It's just it's more about accessing that right kind of funding at the right time and with the right strategy behind it. So whether you're trying to start out, grow, scale up, without capital, even your best ideas can stall. But often accessing that capital is the biggest challenge. So in this presentation, I'll just talk to you about different options available, how you can position yourself to be the best place to access that. So we'll dive in and feel free to ask questions. Okay? So this is one of the, if you go to any lender, that seek capital, this is sort of the matrix that they'll sort of categorize you with, and it's something that you should be aware of and consider, and it's all with 4 C's. So that's character, capacity, capital, and collateral. So what does that mean? And this is what the banks use to assess you when you, apply for any sort of funding. So character, so it refers to your business acumen, your reputation, credit history, record of repaid debt. They'll assess your background as a business owner, if you have been in business or any experience you may have. To look at your credit history, personal experience, business experience, tax return, your payment history, how you pay off previous loans, legal issues, if you've had any, job stability. So it's a whole range of things that get looked at. And that's the most important things that banks would consider when you look at, applying for a loan. The second thing is capacity. So this is straightforward, is, your ability to repay the loan, and that's assessed on obviously the amount of loan that you're applying for. And are you going to be in a positive cash flow? So what Ali sort of looked into. So taking out this loan, will that still keep you in a positive cash flow? That should be the number one question that you're asking yourself. The next one is capital. So this refers to, skin in the game. So if you are asking for a loan, say of 100,000, are you able to shell out at least half that cost? Rather than ask the bank for 100%. Unlikely that you get 100%, but what the bank look for is to see how much can you put in as by yourself. Okay. So that's, and it'll look at, obviously, you can also look at other assets such as cash, equipment, and machinery, or any investments that you make into the business that could qualify for capital. And the last one is collateral security. So this could be any item that a bank could use to secure the loan. And that you know, it could be your house or a car and something like that. And it improves your chances of being eligible if you can offer security. So it could also give you a lower interest rate. So it's a good idea if you can to think about offering security. Because it improves your chances. And the last thing in security is the guarantee. So as a business owner, you would most likely have to sign a guarantee as a director of the business, or if it's not a company and it's as an individual, because you're responsible for the business, so you have to sign most likely a personal guarantee. And guarantees are if you fail to pay, or if your business fails to make the payments, you'll be personally liable for that. So keep that in mind. Of the guarantee. I'm skipping through a lot of things, so if there's any questions, just feel free to ask. I have a lot more information than time allotted. So these are some of the questions you would ask when thinking about finance. Do you need money up front or or you know on an ongoing basis? What is the maximum repayment for? What's your loan to value ratio? What assets you have to offer as capital? As collateral? Do you need a guarantor? Or can you be a guarantor? How much equity do you have? Or what percentage of shares are you willing to offer investors if you're looking at that option of financing? Which brings me to this point. There are two types of financing. There's debt financing and equity financing. Debt finance is, you know, what you borrow from the bank, from the lender, and equity finance is when you offer investors a share of your business. So some of the, I'll go through some of the disadvantages and advantages. Debt finance, you retain your full ownership in the business. You don't have any obligations after you make all the repayments. Interest is tax deductible, and you can have, you know, shorter long-term options. Disadvantages, there's minimal opportunities for startup. You know, it can be quite expensive. And obviously, you have to make repayments with interest, so that's there. And quite often you need to provide some collateral. It's a little bit, with equity financing, have no debt repayment. You get advice from equity investors who are typically experienced in business and providing you with expertise. They're happy to wait for their return on investment and can provide funding, obviously, when you come to bank. So the disadvantage with equity finance is that you forfeit of revenue to investors. And you have to sometimes seek their consultation when you get changes. So what you want might not be, you know, taken into account as well. These are some of the funding options. So there are a ton of funding options. I know Lizzie will go through some of the vendor finance, so I'll skip through some of them and I'll talk about sort of the main ones that a small business you would typically use. So the first one, which everyone, you know, you would potentially use as a startup business would be credit card, overdraft, and loans. I'll talk about that. But credit card is an easy way to access and make small payments as a business. Interest rate, if you're paying within the payment window, usually it's between 40 to 55 days. Short term, so, and it's, you can collect potentially points. One of the biggest downfalls of the credit card is very high interest rate, especially if you're carrying a balance. It can take years to just pay off very small amounts and potentially high annual fees. So the key to accessing credit card as a finance option is to keep the limits low and only to what we require. Because if you have a high limit, it can hamper accessing any future capital requirements. Because when you apply for loans, the banks look at your whole limit and not just what you. So that this plays a factor, you know, you may need a personal credit card, not just your bank, business credit card. An overdraft is a great option to ease the cash flow because it is just a limited cash to your bank account. So when you don't have enough funds in your account, you automatically draw on your overdraft. It gives you flexibility to pay back, you know, your suppliers, for example, keeps cash in your business. It has a higher interest rate than loans, so it's just meant to be more of a short-term finance option. Going over your credit card, so your overdraft limit will negatively impact your credit rating, so it's important that you monitor if you don't go over that limit. And it can be potentially a debt burden if you don't manage it well. So if you're not paying it down, it can just stagnate and just be this ever growing limit. So you always want to make sure you keep paying it down. How can you use your overdraft? Ali talked about cash flow and reducing the payment term. So for example, if you need to pay wages for a job, you use the overdraft. If you haven't received funds, for example, from the job that you just did, and you can use the overdraft to pay your employees, and once you get paid, pay down the overdraft, and you can ensure all your payments to your employees and contractors are done. So that's a way a simple way you reach overdraft without paying too much interest. So that's. The other one is loan. So loans, again, is one of the most common funding sources available. Choose between a flexible or a fixed or variable loan. You got fixed repayment throughout the long term. You can potentially get access to large amount of funds, you can retain ownership, and there's shorter long-term options available. Some of the disadvantages of loans, it can be sometimes a long approval process, depending on the circumstances, often requires collateral. And you need to make the repayments regardless, whether you're having financial difficulties. But I always encourage you to talk to your lender early if you do have financial difficulties, because there could be some leeway you could get or, arrangements. So keep that in mind. Don't always wait, until you miss 2-3 payments, then you go 9 days possibly. So just a caveat, but maybe not just only loans, but even the overdraft. The next one's the payment arrangement. So the payment arrangement is an agreement between a creditor and a debtor to pay off debt in installments or under modified terms, but often used in bills, loans, or taxes. So a creditor is a person who the debt is owed, so banks or suppliers, and a debtor is someone who owes the debt to another party. Some of the advantages of payment arrangements, you get flexibility that allows you to spread payments over time. You can avoid late fees and penalties, prevent service disruptions. It can help you avoid disconnection or eviction, and it can protect your credit score. Disadvantages, it extends your debt because you stay in debt longer. It could be possible higher costs for fees, and there are strict terms and conditions. So missing payments could maybe void your agreement, leading to penalties or legal action. And you've got limited negotiating power with the suppliers, for example. So an example of where you might use it, if you're, for example, an electrical business and you have a payment arrangement with an electrical supplier. You purchase stock on a needs basis. And for what you need for a specific job, and then when you get paid, you pay back supplier on completion. So the benefit is you're not tying up your funds in inventory. So you improve your cash flow and that's something that how you have to. So this is how you can use this type of service without, going to pay an overdraft option. But, and again, it just depends on the type of the. I'll skip over vendor finance and I'll leave you to talk about that. The grants is something that I look at in my current role. Grant funding is, something that's available to a lot of different businesses. Major advantage, you don't have to repay the money back. You can, it increases your credibility because it can boost your reputation and make it easier to attract further grant funding. It supports innovation and growth. There's projects that might not get traditional funding can attract grant funding. And you can combine it with other types of funding to reduce your overall cost. Disadvantages, there are some strict eligibility criteria. It can be competitive. Every grant is different, so you need to be across all of those terms and conditions. You have strict reporting requirements, and there's limited availability of grants, and it's just getting more and more hard to access these grants. Key point to note that you can't consider grant income and business income. I think that's what you made as a business, so just be mindful of that. When you're seeking finance, on to that appeal. I'll talk about a chattel mortgage. So this is basically like equipment finance. It's fancy word chattel. It's any sort of financing, it's like a loan, but you're securing it with equipment, vehicle, machinery. The advantage of this is similar to loan, you can retain ownership, lower interest rate because it's secure loan, and you can get flexible payment options with, removed at the end, so it's really upfront cost. Tax benefits for that, and it's usually an easier approval process than just a traditional call. Disadvantages, you've got repossession if you don't pay, or if you default, depreciation risk, so that is if the asset loses value quickly and it might be worth less than the loan. That's it. It could be ongoing front admin fees and upfront costs. And the next one is a lease. So for leases, it's very similar usage for lease. You've got little or no down payment that you can make. You've got your fixed monthly payments. Potentially access to the latest technology. You've got tax benefits, and you don't have to worry about reselling the asset. But that is taken care of by those. Disadvantages that you don't own the asset. That's the long-term cost could be high because you have to, keep leasing if that's what you're doing. You've got restrictions, on mileage if it's a car that you're leasing or modifications that are made. There's penalties if you terminate a lease and ongoing payments for as long as you have it. So those are some of the two considerations usually for vehicles and machinery, either lease or equipment fund. Hire purchase is a type of installment plan where a buyer agrees to pay for those percentages. So it's usually in a similar way to purchase more expensive equipment or machines. similar to child mortgages, we've got fixed installments, flexible terms, and ownership, but at the end. The disadvantage is you don't have ownership until the end for the final payment, but the depreciation or you repayment fees, this what we potentially call. So these are some of in a nutshell, I don't I can do quickly, but the different sort of financing option. Now, how do you choose what's best for you? Ultimately, that depends on whether you want to own the asset, which is typical sometimes for vehicle or equipment, how much you can afford to pay upfront, what your preference is, fixed variable payment structures, how often you need to replace the asset or upgrade, and who is looking after the maintenance. So these are some of the considerations you need to think about in choosing what option is best for you. Your accountant can also provide you with advice on which respects from a accounting perspective. So these are, some of the things to consider. Setting up your finances. So this is, as starting up a business, this is something that I like to work closely, and Beck and T would like to work closely with you is number one is calculate the startup cost for your business. So it's important to understand what you're getting yourself into, how much that's going to cost you, and know what we need to, for day one. Okay. Understand the financial terms and what they mean. Before engaging with a professional. And it'll just help you make more informed choices and decisions. Create a budget. So your budget is the planned revenue and spending, and it allows you to allocate funds. So by doing a budget, you'll be able to see ways you can cut costs, avoid spending money on any non-essential items. And if you have extra funds, think about how you can reduce debt, create a safety net, and how you can grow your business. Setting up a business bank account. So that's not always a simple thing. You need to understand what offerings are available locally, what are the costs available. So a lot of people usually go where they have a mortgage, but you might want to consider, what fees are out there and interest rates, those kind of things. Payment methods. This is how are your customers going to pay you? So a lot of people they would look at digital options. So whether it's FPOS or Square or any of these things, make it easier for people to pay you, because if it's easier to pay you, you get money, cash money is better. So payment methods are very important to consider. Find professional support for your business. So accountant, business planner, that sort of thing. Accounting software, very important, which Ali also alluded to. It makes your life easier. It makes, and what he said about when you just start business, start putting things into, automate your system right from the beginning. It's easier to do that upfront or at the beginning rather than change it down the line. Also, if you're looking to seek financing, banks these days can or get access to your zero or high off and provide you with financing based on that to avoid going through all of the documentation and all that. So if that's not an incentive to get you that. And it sets you up for good record keeping, saves you in fees for the accountant. And Beck and T post through the ASBAS programs, training on 0 and 1. So encourage you to definitely, look at that also. In terms of what documentation you need, business plan, is one of the most important documents. And think, as you're in the startup phase of the moment, flesh this out, have someone else look at it, do your research, make that part of your business plan, and make it a fluid document. A lot of people, do have a business plan, put it in the drawer and then forget about it. It's something that you want to revisit and make it sort of an ongoing thing. Cash flow forecast. This is something that if you are seeking financing from a bank, they want to see a cash flow forecast. And I'll go through an example Dave with you, and I actually have paper and copy of that. Vendor financials applicable if you're buying a business. Startup costs, again, very important to know what costs and what it's going to cost for lease agreements, statement of position. So this outlines all your personal net worth, assets, liabilities, income, pay stub, bank statements, tax returns, a loan application. It's a lot of documentation for any kind of loan. So this would be an example. Lizzie, you've seen this already a lot. This is an example of a statement of position. Won't go through all the details, but you're really looking at your personal cash flow in here. And the bank is going to be assessing you on the expenditure, spending habits, assets, liabilities, and then discretionary and non-discretionary spending. So your must-have, your essential spending, your lifestyle. So a very common thing is just be as accurate when filling this out as possible. Don't underestimate your expenses because it just loses it makes you lose your credibility when applying for business loans. And the banks will use benchmarking anyways, so you just want to make sure that another common thing is when filling this out is to make sure you don't double up on some of the expenses. So if you're spending items, like for example, you pay insurance through your credit card, and you include it with your credit card up top and the insurance, so that's doubling, where you're including it. So talk to either your bank or your broker, whoever will help you with this, so that you're separating that. Common question business owners ask is, why do I need to provide this? Number one, it's to understand your current financial picture as you provide personal guarantee as a director or owner of the business. Provide info into your credit history and your overall debt. And it supports the 4 C's that I talked about in my first slide. So character, capacity, collateral. So it just helps understand your financial. This is an example of a startup cost calculator. So be realistic, don't underestimate the numbers to make it look small. Just make sure you've got a plan for sort of mitigate any sort of risks in here. Plan for any shortfall and just demonstrate how you can overcome it in your business plan. And so this is some of the details that we need to start from the startup costs. Here's an example of the cash flow. So cash flow is an estimate of your sales that goes month by month. It's a useful tool to help you understand if you have enough income to cover your expenses month over month. You plan for any payment cycles and seasonal trends. It helps you predict any shortfall and surpluses. So here is where you use estimate cost. You just need to label what the estimate and how you came up with those figures, have a plan for that. And whether you're using this again. So this is some of, this tool is again very important when seeking financing. Or if you don't seek financing, but just to know how successful your business is going to be. And, backend team can help you with this, your accounting can help you with it. So it's important, this is very important. We'll do one quick exercise. And just to talk about that cash flow. So in this example, both John and Adam are looking for 50,000 business loans to start their business. Who is more likely to get it and why? So in example one, scenario one, Adam is working as a barista with an annual income of 70,000. We've got an asset, it's 500,000 in a mortgage. He rents out a bedroom, has some rental income coming in. He's got a car, 20,000. He's got a credit card, and that's very expensive. John, the self-employed plumber with an annual income of 120,000. He's got a primary residence, 850,000, and a mortgage on that. An investment property with a mortgage. So he's got rental income coming. He's got savings, 50,000. A car, credit card, and higher level of credit card and some maybe. So just take maybe 2 minutes or 1 minute and just think about who would be more likely to get that loan and why. Any thoughts? Anyone want to go?
Scenario two, it's got more equity. He's got higher cash flow, potential to pay back loans.
Bang on. So John's more likely, assuming all his business financials are good. If he has experience in having and running, having a business and running a business, so that speaks to that character piece that I talked about. He's got savings to fall back on. That's capital. He can potentially do a barista course to get some training on how to do that. That's a criteria. And he's got equity. So that's an equity calculation just based on the numbers I did. But if the bank has to secure a loan, they can and they have that option. Where you get, differential interest rate. So that's how banks sort of would look at and evaluate an applicant. This is an example of an ATO benchmarking. So whichever business that you're looking to set up, always and when you're especially establishing your cash flow forecast, very important to make sure that it fits in with ATO benchmarks within those ranges. So any type of business, you can just search benchmarks and you'll find relevant benchmark that works with the type of business that you're looking at. So you want to make sure whatever you're producing in terms of cash flow is sort of this would be an example of cash flow forecast that's prepared. And I won't go through this in the interest of time, but I can provide this example just so you can see what this looks like. This is a recap. Provide evidence to reflect any of the numbers that you put in your startup costs, cash flows. Engage with professional. Be prepared to discuss your work history, business history. Always give yourself and the lender time because this could take quite a while to get through a lot of documentation. don't ignore the risks or deficits. Make sure you have a plan to mitigate them. So for example, like when COVID hit or there's any sort of shutdown, how are you gonna overcome it? Make sure you include that in your business plan. Reach out to Beck and T for support or myself or people in my team, our territory business advisors, we're located across the territory, we have coverage for everybody. So yeah, that's it.
For a pure startup, how difficult is it to get a bank loan? If I'm starting on day one and I need some cash to start my business.
Then it can just.
Let me just add, the irony that Nephra was the first one to actually give us a facility back when we started.
Oh, yeah.
Business in 2020. And at that time, we didn't have security, so we got a $10,000 credit card. But that was also because we had supporting contracts and invoices that we had already issued, so that also helps.
Yeah.
If you have secured invoices and contracts that say that you have business coming in.
Yeah.
And that worked for us.
Nice one.
Thank you, Nephra.
The Nephra started you off.
Yeah,
That's amazing.
Thank you.
Thank you very much, Nephra. Wonderful. Next up, Lizzie. Hi, Lizzie gives. Lizzie, well, she's going to tell me about herself anyway. Thank you very much. But Lizzie has bought and sold her own business. Sorry? Yes, you know, if you want me to shout it from the back, I've got it over there.
Yeah.
Here's a little microphone for you. Lizzie, budgets, everyone.
Hello, everybody. Just like that.
Just like that's my new doing.
So this is a little bit about me. So I'm a business buyer, seller, and succession strategist. So 9 years ago now, my husband and I, that's us in ANZ. My husband and I bought my dad's plumbing business in 2017. Last year, almost 12 months ago to the day, we sold our business to our managers. And through both the buying and exiting process, I experienced, I guess, the shortfall in the market for exit and succession strategic support. So that's where I started mine. I'm now a business startup as well. For Nephra Partners. So it's a little bit about me, a little bit about my background. In the 7-year period, we owned the business. We had 3 kids. We bought the business with Nephra Finance. He asked me a question about how far is it to get a loan. Really good. The business, the banks didn't want to know us, so thankfully Dad was able to get finance, and I'll talk a bit more about what that means and what it looks like. So, disclaimer. I am not an accountant. I'm not a lawyer. I am not a tax advisor. I am a lived experience business owner. I do have a certificate in exit planning, but anything tonight will be education basis. So is that the good? Okay. Why buy a business over starting a business? And why now? So why now? At the moment, Australia is going through, it's actually not just Australia, it's going through its largest transition of business ownership we've ever experienced. You know, the boomer generation is the largest generation population that we've got. And a lot of those business owners, a lot of them are now getting older. So there is a transition of business ownership happening. So at the moment, we have more businesses on the market than onto the market than new buyers. And so there's a real opportunity at the moment with that. And why buy? So startups are actually cool. Startup, entrepreneurship, it's awesome. Really hard. Who loves to startups? Starting up has been really challenging. It's been an experience to me, whereas I started the other way around. Whereas if you were to buy a business, well, it's cool, it's not put your own twist on it, kind of, but the benefit of an established business is you buy it the next night, you've got cash flow. The next night, you've got customers, but when you put your ground on essentially. So there's a lot of benefit to buying a business in that sense. Established businesses as well, quite often are more successful, but the older businesses are more likely to continue to exist. Is business ownership right for you? Business faces those who try to live in challenges. It is not easy. It does not rest, not get breaks, even looks really fun, and it is fun. I think those of us who are in business and continue to be honest, it's good, but it's fun and it's hard, and it will demand more from you than you can ever expect. Now, finding the right business for you. So I've broken up businesses into 3 different areas. So some people, I guess, when you start a business, you start with your accounting firm, or only generally going to start your accounting firm. If you're a tradie, tradies a lot, they go and start their own trades business. Where you're buying a business, it's a good way to acquire what you already know, but there's also an opportunity to buy a business that you may not have the skill and experience in. But it could be a sidecar, or it could be something you mentioned you don't want to be there for you. So when you buy a business, I guess the way I've broken it up is time heavy. So the businesses that are time heavy, they require a lot of time, a lot of your time. They break the flip and growing or digitizing. So something like a legal firm, obviously with AI. Legal firm is quite heavy, a lot of reading, documentation. If you buy an opportunity, then you could essentially flip it, digitize it. The operational is going to be the rest of you. The risk is burnout construction. Specialist heavy, so things like specialist this knowledge in great. He's a specialist, right? Sometimes, most of the time, specialist is more profitable and have a lot higher key customer risk. So if Greg is an awesome technologist of the business, then there's high key customer risk, which benefits sometimes the Greg business. It can be extremely challenging to recruit and replace specialists. If you are the specialist versus being trapped in operations, and then we've got asset heavy. So when it comes to banking, it can be quite, it can be able to borrow against, because they can use that as equity. Fewer people required, lower specialist skill barrier. However, there is time limit. So I guess when you're looking to find the right one for you, really looking at where do you want to be spending your time, as well as which is the right risk, whether it's fit, whether it's time specialist or method. Something else for a consideration when buying a business, so your ideal owner experience. So we talked about business plans, we've got a spoken about, which is great. Another consideration is what you want in buying a business. So if you have personal goals of having kids, for your sales. If you want to go on a business holiday, if you want to support aging parent, you want to retire at 50, then having a certain type of business won't support business goals, whereas a different kind of business will support that. If you've got financial goals, if you want to lash out and have your dots, then you probably need a business probably more than high growth area. Whereas if you just want to make enough money to buy a small home and live a reasonable life, then a home business. Business goals, then if you want to have a high turnover with high profits, then cash flow growth, national, international, then again, those goals will determine what business is best to do. So once you kind of knock out what your personal goals are, your financial goals and your business goals, it really helps you to meet them and figure out what sort of business acquisition. There's a lot of information at the moment on the market about business line related extensions, and human creative guide would help you really narrow down what business is going to best for you and what you want to buy. Some people are more visual. I'm a bit more kinesthetic. So I need to really get in, touch it, understand how things operate, how does the business operate, who's involved, to really, I guess, understand whether it's a fit for me or not. So if you're more visual, I highly recommend a visual guide, but anything to sort of help you really picture and understand what sort of business you want, what direction you want to go in. I highly recommend you create your own guide or using a guide that's bigger messages. That's the thing. Super helpful. Anything that you can get is great. Now, understanding the process. So, the professional will help. If you're at the beginning, obviously lots of startups, funding, cash flow, all of that is minimal. So, you've got an accountant, a Lizzie. You can need an accountant, a lawyer, usually a broker involved, unless it's a seller. I'm a lawyer. So make sure you have some professionals in your back pocket when you are ready to get them to assess. And then search. So when you search, you can go online and search about for businesses that are for sale. Real estate, there's a few online go through. And then you're like you go to a shop, you go to retail, or you go into car service and go to the agent, chat, put what their plan is. Do not ask an owner directly if they want to sell their business. If they like, that's very polite. You know, what do you know my business? No one wants to tell anyone they're selling their business, especially in Darwin, but now, free speak now. Not talk about it. But once you build rapport and build a relationship, then you can have more of a conversation about the future direction plans. Hey, Darwin, I'm in the market to buy a business. Opportunity. And then we go into the phase. I'll get more into that. Buckle in because it's quite a fun journey. Due diligence, I'll go more into that as well. Settlement, day one, and first year. Big process. Exciting, it's fun. But where's the money? Want to buy a business? Thanks. Sorry, I was really hard to win over. What options have we got? Where's the money? This is where vendor finance comes in. Now, in Australia, from my experience, vendor finance doesn't have, it's not super attractive. Vendor finance is fine. Don't give it to a vendor. Vendor finance is specifically focused on the seller. However, this is starting to change. In America, it's called seller financing, and it's the norm. At the moment, you want to buy a business. If you want to go to the bank, so recently we're looking at the business and ran Debbie, actually I don't know how I said, I said, hey, look, there's a business, what's the current lending position for business? Okay, let me find out, I'll come back to you. So I rang me back the next day and it said, essentially, if you want to buy a business, the banks want you to have about 50% of the sale price of equity. Yeah, which not many of us have. That's a lot. So that's one option is the bank, money to sell, or you speak to the seller and then the client. So this is where the seller helps you to finance the purchase of the business. So they don't give you the cash, but they let you repay them from the profits that the business generates. It's usually structured as installments over whatever the period is you negotiate.
So you did vendor financing.
Yep.
And you had year two and you paid off 10%. You're saying that you paid them back with the profits.
Yep.
But if you only have paid off 10% business, do you get all the profits or do you only get 10% of the money?
So I'll solve that in a second, a little bit. But essentially, can I check my same thing? Federal finance is majorly based on trust, relationship, and agreement. So it is a formalised legal agreement. My biggest word of advice if you go down this route is to have a solid relationship with the vendor. If you do long hard times, like in my experience, we bought the business in 2017, 2019, with the quiet security that had that long time. COVID saved us and a lot of other businesses, and then we went through COVID as well, which was also challenging. For about a year, and then it was late again. Well, I'm not getting COVID. I'll be up here. But if you can maintain that relationship without understanding, then it just supports the process. It also supports if you need advice from the vendor and they're no longer in the business, then you can bring them and still have a relationship and they can still give you advice on operations, on strategy, all that sort of stuff. It's definitely better. Okay, so example. And this might answer your question if it doesn't, I will be definitely. Okay, so let's say we found a business, Hodgets business. Been operating for 20 years. The business turnover revenue is 2 million. Business EBITDA. EBITDA is a fancy way of saying profits, right? Yeah. Of 400,000. Yeah. Now Bob is asking for $1 million. I don't know if I'll tell you what that value range is. That's 2.5. Yeah. But when we go through the due diligence, when I go and see Ali, say Ali, Bob's, I want to look at Bob's trade business. Here's Bob's financials he's given me. Can you let me know what you think is worth? Ali goes through the financials and he goes, actually, because of the EBITDA profit, as well as the current market, the current climate we're in, some other, accountancy experience, I would say it's actually worth 600,000. So there's a difference in the asking price and the difference. We then go to Bob, okay, Bob, we want to buy a business, but I can't get a bank loan, or I can only get $100,000. Are you open to vendor financing? Now, it is a risk on the business owner. So when we negotiate vendor financing, it is often a little bit higher of the negotiated price than what we might have in the business get the bank loan. Because they're taking on a risk, right? We need to respect that. It is risk. So we go to Bob and said, look, I'm willing to negotiate and do vendor finance. So we give Bob $100,000, we negotiate based on vendor finance.
Sorry, it's touchscreen.
Negotiate from $1 million down to 50,000. Now, we also know we're working with Ali for that Bob's business during due diligence. We've got the month-on-month finances. So we know that for the first 3 or 4 months, the cash flow is going to be about 40 grand to pay everything that runs the business, wages, operations, rent, everything else. So we need to make sure we have that working capital as well. So we've got $100,000 from equity, say that goes direct to Bob. Bob finances the $700,000 size, that sits in our balance sheet of the loan. And the loan's for 6 years. We give Bob a 5% interest rate. And then monthly repayments come out of the profit. So your question. So one thing to really keep in mind, this is where we went wrong. We didn't go wrong, we just didn't have enough experience and understanding this. And probably not with your dad. So when we bought the business, the monthly profit was about $12,000 a month. The vendor finance with payments were about $11,000 a month. So we had $1,000 left over a month in profit. Again, profit's different to cash flow. What we didn't understand then, that I understand now, is that when you want to reinvest back in your business, you want to grow, when you want to go and get a vehicle loan, those other loans also come out of profit. So we didn't have enough profit left over to reinvest back into the business, you know, get more staff, get more equipment, all the rest of it. So if you're looking at buying a business, even if whether it's vendor finance or bank loan, you need to make sure that you've got enough profit to repay loans whilst leaving yourself enough money to reinvest back into the business. When you're calculating all of this, make sure all of the profit is not taken up in loan. It's a lot, but I can solve it. Was there any questions on that?
Can my deposit be from a bank?
Yeah, so you can use, if you go to the bank and say, with your big pile of paperwork and talk about it. Sorry, I'm taking a little bit of this benefit, but it's the reality, right? You go, hey, Nephra, I want to buy this business. Here's my business plan. It's 20 years old, so it's got a good brand. If there's on the market, so there's brand in it, there's goodwill. It's profitable, and I've been working for Bob for the last 5 years. So I know how the business runs. I can jump straight in, and it will continue to operate that way. The bank goes awesome, so you can cover up the initial 3 Cs, and I've got $150,000 equity in my house. We might be looking at this in cover the 3 Cs and put equity in front of it. It's like us. We went in 2017. So I bought my house a year ago. We put all our savings into the working capital. We have a 1C, sorry, we worked in the business for 5 years. So then they don't mind as well. Other finance options, again, the guys were spoken about it. Just not be covered. So due diligence, what is involved in due diligence? Due diligence is where the truth lies. So profit and loss balance sheets, you can move things around. Once you get as a business owner, you can too much, but
Don't let that out.
so we were doing remote plumbing work that needed a buggy for driving access. Right? It's a legitimate purchase, fine. That's in your profit loss balance sheet, it's an asset in the company, but that won't come with the company, that won't show up in the initial memorandum, this is a due diligence comes through, right? Okay, so profit, the financials you want to get, the profit loss balance sheet, also really want, we talked about as well as not profit, revenue. You also want the monthly profit and loss and cash flows. Because if we're buying a business in Darwin, going buying in November, we're probably going to be cash flow negative for 4 months. If you buy a business in Darwin in March, that's probably a better option to enter in because you're going to be cash flow positive the majority of industries.
Business, no, everyone.
True, aircons full. Applying technology. Because of live all business in like October, that's been hard. But you won't know that unless you have your cash flow monthly, okay? So cash flow monthly will also give you an indicative of when to buy the business, when to do things. You don't have to do a financial year, a little bit cleaner for your P&L and financials, but you can do it whenever. Systems and processes or lack thereof. So under my bulk trade business, I was still paper-based. I also had five 2 years ago, and so 2 years, been operating for 20 years, but I've only got 2 years documentation. So that's amazing. That doesn't improve much, doesn't help. Bob has 3 team members, and they've all been there for 10 years. That's amazing. What happens if they leave? Is any of their jobs documented? Do they have position descriptions that actually tell you what they do on a day-to-day basis? Staff and culture. High turnover. If they've got high turnover of staff, why? Why is that? That's going to be really painful to come into. If you come in and choose to leave, then you've got to recruit those straight away. So wanting to make sure they've got a good staff amount and a good culture. Is it a family-owned team? So there's quite a few businesses in the company that are family businesses. Kids are in the business. Again, if they're going to be there, and this is again a part of the process, negotiation and having that long-term conversation. If the kids are in there, how long are they going to stay? What's the impact of the system? Legal and compliance. If the owner of the business also owns the shed that you're in, is there a lease agreement? If there is a lease agreement, has the owner made a 10-year lease agreement? So then you're coming into a property, that's a 10-year lease on it, and the property might be not suitable. If there's no lease agreement, then there's if they are a registered agent or a product or a system, is there an agreement in place for that? If there's not, again, there's risk that you hold that. Customers and pipeline. So who's buying? On average, better is a high risk business as a customer of 30% on the world revenue. Right. Okay, so if you buy, if you are buying a business and one customer is 30% of the revenue, that's risky. So you want to make sure that the revenue, money that's coming in, is spread evenly across the business. So that if you lose one customer within the first 6 months of their high income, that's really high risk for your revenue.
You pay contracts in play at that point as well.
Yep.
So do you have contracts if you're going to be
Yeah, you definitely take that into consideration. If someone has an anti-government contract that's every 2 years and that's 30% of the business, that's not reason. Because what's to say we're not going to be able to do this time. I'm going to shift the systems.
Like South Lake question, 25%.
Okay. Yeah, 25% I want them. These are future proof. So Bob's trade business might be full but with full cleaning robots, AI, all the rest of it. What's the future of this industry look like? Especially now with AI. We There's a few different businesses that you can look at that if you don't find this time. There might be a negative report. As opposed to negative growth. So that's another consideration. Any questions? Then common red flags. Owner is the business, again, key person, legal people, owner leads and the business. It's no financial documentation. You'll find in that, especially there's quite many businesses that's paper-based. So that's a red flag. A cash business. There is a small business for sale at the moment. Split the cash. So is their turnover actually their turnover? Hard to know because it's cash. High teen turnovers, we talked about that. The business has been run down, but the owner is asking for top price. As a red flag, unclear leases or supply rents, talked about that. No systems, reluctant to share info, so if the owner wants to sell, but they're not actually telling you much about the operations of the business then. That's a red flag. If the owner is pushing for a fast sale, that can obviously be red flag. Why don't they sell for fast? If you feel rushed or unclear, do not ever feel pressured. You've got to think of something you have to set yourself down. And the other price is right. So there is a pricing formula. Accountant can help you with this. If it's a really big business, there's a specialist for valuer, valuation, that kind of money. But there is a value range, and these specific valuations that I got recently for different industries. I believe so. Value ranges are also I like to simplify it down to like right. A 3-bedroom, 2-bathroom house in Bunny Bay is a different price to a 3-bedroom, 2-bathroom house in Malden. Right. So whilst there is value ranges for industry, these value ranges also are impacted by their location. And location implies state and territory. Maybe not why Bunny Bay the house with it. So if you do find a business you like, your accountant will also help guide you. My best mate ChatGPT also. So what is a seller looking for? A seller is looking for a trusted successor. When you have built your levy, built your business, and a lot of business owners that are in their 50s, 60s, 70s that have built their business from the ground up. Their identity is planning this business. So they really want to make sure that as a buyer, they're going to respect and take care of that business. It is a very personal process. It is an incredibly opportunistic process. And the right seller with the right buyer can make a really incredible transition opportunity for both parties. Okay, wrap up the next steps. So remember, you want to run a business that aligns with your goals. So really work out what goals you have for yourself in the future. Yeah, see what business you can run. Cool. Any questions?
I've got a question. You were talking about Bob's business earlier on, and this might be a kind of combined answer potentially. What's the appetite for banks for leveraging off of the existing profits of that business? So you might not have a lot of your own cash, but are banks open for leverage here?
longevity there. It's not, projections, like at the startup, so that's definitely looked more favorably. As a purchaser of an existing business, you want to look at not just the last year's financial, but you want to look at a few years, and maybe COVID as an example, just to see how the business has been, operating over a few years, because as Rudy mentioned, sellers can sometimes manipulate some figures here and there, just, if they want to sell. So as your as a purchaser due diligence, you want to make sure you get a few years.
So the bank, let's say I don't have much of my own cash, is the bank likely to allow me to get a loan based off the profits of that business, or am I still going to really need to have some assets, some collateral to put up? Yeah. Yeah. Yeah.
Might,
Yeah.
I mentioned in my presentation as well earlier, the security group view of lower interest rate.
Yeah.
That's something to think about. If you can offer it, it's worthwhile.
Yeah. Thank you.
I wouldn't mind that, but
Yeah, Mike.
this one's for you. So let's think I'm a plumber. I've just finished my apprenticeship and I'm very hungry. I want to out my own. Do you think the current opportunities would be that of businesses that are coming up for sale, or the older generation leaving or possibly leaving? Would it be beneficial for me to start my own plumbing business, or would it be a good opportunity to start looking for where I'm going to sell plumbing businesses to purchase? Or the challenge?
Well, let's walk through this one together, okay? Alright, so you're a plumber, you're a tradie, and you want to buy, looking at starting up a line. Starting up costs a lot more than I think people realise now, especially as a tradie. All of your equipment, which you've probably gotten through your apprenticeship, you still need stock. You need software systems, which isn't just zero, ServiceNow, Google, whatever you choose, right? You then got to go and find your customers. There's a lot of funding there in the trade space now. So you can compete, and then it depends how quickly you want to move through the business ownership. Let's call it career, business ownership career stuff, right? As a startup, you'll go through the first 12 months. You might break even, you might not a little bit. So the first 5 years, right? Statistically, the first 5 years, 50% or more fail on average. The next 5 years, even more fail. So whereas if you buy a business, you could buy a business. So for us, it was a turnover was roughly $2 million. So from the next day, buying that, we had that turnover. We could then grow that turnover, or we could reduce it. We could move things around. We could choose what we wanted to do. Yes, we had to pay off the loan, but in that 5-year period, instead of risking the potential of failing off our own back and leveraging out everything into that, there was more of a chance that we were going to be successful statistically. And because we've been in the business, and because my husband had to take the money. So once that 5 years is paid out, I'm then guaranteed revenue still, statistically a lot more likely, of $2 million with a percentage of profit that then comes to me directly. Whereas if I'm starting out, like that took Dad 30 years. And on average, to get to 2 million would take 5 to 10 years. Yeah. So it's a quicker trajectory business-wise, but again, it depends really what your goals are and what you want to do. There is also culture situations in business as well. Obviously, with Dad's business, it was well known in the market. The brand is well known in the market, but there's also some associations with that brand in the market as well. That might not have to do with us. It was fine for us because we knew it and understood it. But that's why in the due diligence part, it's important to understand how the brand sits in the market, positive and negative, to really to base your decision on. Yeah. Thanks. Yeah.
So now I'm starting out, I've just left my apprenticeship and I'm thinking best to buy a business because it fits my goals. Get up to speed quickly and buy my yacht. When I go into negotiations, being very part of new business, how should I frame myself when I'm going against someone with 30 years experience building my own business?
What are you going against?
Well,
How approach it?
how I approach this person with the 30 years experience and I've just finished my trade, but I'm most hungry. Would you offer any guidance to someone negotiating, negotiating battle that maybe you fell down at?
Yeah, Lizzie on board. Gotta do it, go do
All right. First, coming from a trade business, if you are a fresh pup just out of your trade, you owe your employer duty. You need to stay there. Doesn't happen. That's okay. If you just out of your trade, how technical do you want me to?
Well, let's just think of it from point of view on, I'm going to walk into a business.
Yeah.
I want to buy a business. Right. And you're going to throw these numbers at me.
Yeah.
I've got to learn a lot. I've got to go startup phase or I've got to buy a business phase. I've got a lot to learn straight up.
Yeah.
But would you encourage me to act like a business owner already and try and figure this out and go confidently, or would I try and just be really friendly, trying to get as much out of them?
The most important piece of the puzzle is the relationship. So I would be completely transparent. If they're not going to be reciprocal, don't hire any business. It is not. If they're not going to. So we went and looked at one recently. And I said, so to open the conversation, I saw online commercial. So I sent my information, said, can I please get the memorandum? He sent me the details. He said, yeah, you should be having a conversation and catch up. And so the financials looked okay. He said, can we come and have a look? Like if it's listed for sale, sure. Come in, no worries. And so we did. We went into the business and we were straight up. We said, look, we currently are keeping our options open to acquire our next business. Financially, at the moment, we would be looking for vendor finance. We don't have capital. I'm starting my own business. My husband also has the primary line business that we have still. So I'm looking for something that is under management and that obviously will need my time, but I can't commit all 45 hours. I have 3 young kids. So the more open I could be with him, then the more open he was back with me. He said, always been on management for a long time. However, this guy's management doesn't have a lot of confidence with the team. You can train him in that, but you might need someone to really manage the HR side. So then I got an understanding of what it actually looks like on a day-to-day basis. So then we weren't wasting each other's time, right? Because that's the most frustrating part. I don't want my time wasted, but also he didn't want his time wasted. We knew where we go straight up. So if you're going in and having these negotiations with a wall up and saying I'm this person, and then it turns out you're not, that's going to start you off on the wrong foot anyway. Is that correct?
Yep.
Just adding, if you don't mind.
Yeah, sure.
Just from personal experience, we just took over an accounting firm 2 years ago. One was in Sydney. So our office in Sydney was a takeover, but our office in Darwin was a startup. We've done people which will be in there, but we're just with the accounting firm. We came across someone who was 80 years old, who was running this practice in 2023. And I had no idea who he was, no connection whatsoever, nothing. But I knew that he's 80 years old. There is only so much time that he will be able to do his books. Right now, he's on a cruise and he's having a great time, by the way. So still alive doing his job. However, at 80 years old, I didn't know how to approach him, but I knew I would be able to help him out. But I couldn't find the connection. Plus, he was a veteran in Darwin and, gone through cycle tracing, so a proper veteran in Darwin, and I was just very, very new. So what we did was we tried to look him up as much as we could. We established a connection from a mutual friend, and it's Darwin, you always find that. We reached out to the mutual friend that we already worked with, but there was a little bit of credibility, and that's where the relationship came. And on behalf of us, we asked the person who actually talked to the guy, and just to put out of the debate. And it was taken really, really well. And then obviously once that happens, you're already 50% in the door. If it's open, you have the chat. And then the rest was just me going with that person, talking. So it obviously counts a little bit of credibility. And there is a testimonial that I'm going with that we've worked with him, and it does the right job. And it worked out.
Yeah, absolutely. Referrals, like any referral, if you refer this to after business to you, the credibility, people really respect that.
Yeah.
There's some really exciting businesses out there. I think that's fantastic.
Where do you find these businesses? Where are you looking?
So commercialrealestate.com has a business buying. There's also businesssales.com. There is an owner. Real estate for owners, but for businesses. Yeah. And then off market is again just you go and introduce yourself. You can generally see if the owner answers, if the owner's greeting you, how old they are. If they're tired, whatever. Have conversations with people. Work in the business, that's interesting. Management Yeah.
That's right. Thank you very much.
Yes. Both Nephra and Lizzie handed out on the work group workshop for the online people going through the link. Your invite to the next session, which is on Tuesday, the last one's business planning. We'll have Dante here to talk about planning for innovation and growth. We have Stevie here to talk about planning for your first employees. Greg Roworth to talk about planning. And then we have the wonderful guys from Ecotech, who are electricians, started in Darwin 7 or 8 years ago. They've grown their business beautifully, and they're wonderful guys that will tell you about the journey and give you a bit of inspiration.
That's it.
So that's it. Yeah, I'll win for you. See you later. Thank you. Cheers.
I've got a few on funding here. I think so.
Absolutely.
Yeah.
Absolutely, 27 dollars. It's like some of the stuff is up to 75 years from your work with education. This time for content. So you know that. It's hard. Sorry, man. Yeah, the NTB funding stuff is something. Stay in touch with any other.
Yeah.
That's in the right direction.
It's a fair idea.
Sorry?
Fair idea.
Very bien, yeah.
Oh, yeah, my personal idea is way less.
Well,
Not bad.
I'm glad that's on the mic. No. But you actually,
I have to have the admin set up for.
yeah, we had, sorry? No.
Yeah, have you on?
Got any fresh ideas?
Yeah, absolutely.
Yeah, so There's also that, and we'll connect. 4 hours with that, there's 3 hours on the conservation programs. That's what.
Well, the personal ABM, so I'll probably work that out a bit. Do you have a?
See you later.
And how long's the take for this application?
Pension background.
Yeah.
That's something organised in.
Yeah, but that's a few minutes.
Awesome. I didn't do the meetings. That's something else. I do accounting. Oh. And a few other businesses as well.
Oh, right.
Yeah, but I want to chat to you about a business that I contract to actually. And everything here to me is the most relevant thing in the world. Right, so we need.
Yeah, I'm glad you
Pretty
did
much.
that.
Ready to leave. But